Hey, good morning, guys. I think most people probably got up and saw a little bit of snow on the ground and cozied back up and went back to bed. So I think most people are going to watch videos today, which is great. What I've got in front of you is the weekly chart of corn, and I want to start with corn here this morning, and then we're going to get to beans. Lots of really interesting things happening technically and especially in the corn market. And so I think that should be our focus. First of all, fundamentally, nothing's really changed over the last week. There's some rumors that China's starting to cancel some soybean shipments. There's a little bit of rain in the forecast in South America, but there's nothing significant enough to change the landscape. It's still dry in South America. There's still issues, and the La Nina pattern is still strengthening. So there's going to be an ongoing weather market out of South America, and I think that's just gonna keep things underpinned here. All right, so on this weekly chart of corn, what should be readily apparent is a trading range, right? We've been trading between this is 2014, the last time we were above $5. We 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 sold off, and now we've been range bound ever since. And pretty much every time we're in this 430 range, it's like a game of whack-a-mole. Corn just keeps getting whacked, and if you're a bull, you get a headache right here in this range. So if you look at what we've done, what we did last summer when we thought that we had a weather issue, we traded above it and we closed above this high for a grand total of 2 weeks. Those are the only closes that we had above this high of 439 on the weekly chart. So if you look at what we are doing over here, we've accelerated nicely, and if you look back, you won't see a trend as intact as this trend is. You can just look at the orderly fashion that corn is marching higher, right? We've started to consolidate right here at this between 4 and 430 level. Now, consolidation generally favors continuation. So if you look at these highs right in here between 399 and 415, 413, which would be the 2017 high, the 2018 high. And then you look at a kind of a intermediate range from 440, which would be the 2016 and 15 highs, from 440 back down to this 410, 399 range, right? So you've got the 17, 18 highs, and you got the 2015, 16 highs. And we're kind of consolidating right inside that range, okay? Now, what happens next? If you read the bears and you read the news flow, most people expect that what has happened over the last 5 years to continue to happen. I think most people are looking for the whack-a-mole to come in and the bulls to get smacked, and for us just to turn around and crash back down to the lows. I strongly disagree with that sentiment, and the reason is that this market isn't solely driven by weather and by South American buying. This market is being driven by something much, much larger that started prior to the weather market. This rally is being driven by demand, not by a weather scare. Weather scares are compounding it, but they are not the sole driver here. So the way this chart looks to me, that we're battling between 4 years worth of highs here. 18, 17, 15, 16. This high is an intermediate one. We challenge through here. We're going to challenge this 465 level, and we get above it. There's very little to no resistance below 520, which is the 2014 high. and I would expect that that number will be seen again before we trade back into the threes. That's a prediction that I'm definitely willing to make as a trader, because this consolidation pattern here is very powerful. Now I'm going to jump back to the daily chart. Here's the March daily chart. I want to look at this here on a little bit tighter time frame. Okay, so this is daily. Look at the closes. So these are candlestick charts, and I'm going to zoom in here so you can see them a little bit better, I hope. These are candlestick charts, and what we're looking at are the opens and closes, which are the body of a candlestick chart is represented by this the colored in part. These up here are called tails or wicks. Not much trading action happened up there. All the trading action is in the bodies. So if you look at where the bodies are, and this is that this close right here is 429.5. We've spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost 3 weeks now, almost 15 days, banging around this 430 area. And we've only closed above it 2 times. Yesterday and the day before. Those are the only 2 times we've managed to close up on top of that. And if you remember what happened yesterday, which seems like an eternity ago, but we opened the day on kind of a panic selling. So the bulls got freaked out right here and they started selling. But they got shrugged off and buyers emerged, and we started buying, and we rallied right back up to that critical level. So now, where is that level in context of the weekly chart, right? This is corn, 439. 430 is right here in this range. It's exactly where we want it to be. We first need to hold this this 18 and 17 range, and then we've got to go challenge this 15, 16 range and break it so that we can work a little bit higher, right? Support becomes resistance, resistance becomes support. You got to break it, then you got to prove it, and then you can move on to the next part of your day. And that's exactly what we're doing here. So let's jump to soybeans and look at the similarities in the pattern. Okay, this is the weekly chart of soybeans. We've been comparing this move up to 2016, which is right here from the very beginning. It looks almost absolutely identical. In 16, we consolidated right around the 1050 area for 3 to 4 weeks. In 2020, we consolidated in this 1050 area for 4 to 5 weeks. And then all of a sudden, we're at 12. And that's exactly what happened back then. It's exactly what happened now. And we finally broke. Where did we consolidate? We consolidated at prior year's highs, 2018, 2017. Once we got a definitive weekly close above that, with this big old outside week up, boom, we were off to the races. Now, on these weekly charts, both with corn and with beans, there is absolutely no technical weaknesses on these charts. They are in fantastic shape, and there's not even a whiff of a sell signal on these charts. So I would not step in and short this market for any reason whatsoever at the present moment, especially in beans. Even though we've rallied $1 in 2.5 weeks, or $1.50 in 2.5 weeks, even though we've rallied it, that is absolutely no indication that beans can't go higher. Because look at what we're doing now. Now we're just testing this $12, $12.08 range. So let's dig in a little deeper and go to the nearby price action on beans. Similar to corn, we broke yesterday. We scared the bulls. Some guys sold, and then I'm sure that there were some 4-letter words uttered on the hedge fund trading floors as they had to re-enter their long positions because they got killed. So here you have this interesting little pattern. Challenging the high, you've got a little hook reversal, you've got a hook reversal. All these closes are significantly above this 1180 mark, which held for a few days, and now this is all support. So it looks to me like this thing's just going to keep right on marching. And I wouldn't be surprised to see us with a 13 before we have a significant correction in beans. And even on a correction, I don't think that's the end of it. I think we've got a full another leg, at least another leg higher after that point, because our balance sheet is just so ridiculously tight. Now, if South America dries up, then and stays dry, and God forbid that La Nina starts to impact us, then I don't know how high we'll go, but it could easily be $3, $4, $5 more on beans, and that's just going to put an acreage war into corn and wheat. So you just there's no reason to step in and sell this thing until something tells you to, and that is just not the news flow. So I don't buy at all that, hey, prices are good, we're profitable, we should sell it. I think that logic is really focused way too much on the nearby, and not to me is not a good reason to sell it. You want to sell it because something shifted that really does increase the balance sheet and put significant downside risk into this market. And I just don't see it anywhere on this chart. So this is clearly an uptrend on beans. We're consolidating here near the high. So the question is there anything on here that looks like exhaustion? Well, no. Consolidation favors continuation. We've got no divergences on the lower charts. We had divergences, they got blown out. So they're irrelevant. That's in the past. This is a whole new deal. There's no divergences happening on this move. And if I drill down into the shorter term charts, even the 36, the 1 hour, 30 minute, 15 minute, they're all turning even more bullish, even this morning as we talk. So I think they're going to blow through $12 and head straight on up. I really do. And if they don't, and they turn around and whack all the way back down to this 1089 level, I think you buy it, because until we get through our growing season, I think that could be the buy of the year right there if it does it. So I'm definitely looking higher, not lower. I just don't see anything fundamentally that would change that. All right, let's look at wheat. So if corn is rallying, right, because it's flirting with its multi-year highs, if corn can rally and beans are going to keep rallying, well, where does that leave their little brother wheat, right? Well, look at what's happening around the globe. You've got you've been talking about ample wheat supplies, but those are all being chewed up because the world's out of beans and the world's out of corn. So wheat's being auctioned off, wheat's being bought, and we're really dry. So if you look at Minneapolis and Chicago, they don't have a whole lot of room to give coming into next year. So it can't lose acres to corn and beans. So you've got this acreage war that's going to happen, and that puts our hard red wheat front and center. And we've been trading this discount to Chicago for a long time. And remember, historically, Kansas City trades a premium to Chicago, not a discount. And we've been trading at a discount because we just have so much. Well, the shorter we get on Chicago, that premium is going to get put right back into Kansas City if we stay dry. So I think Kansas City is about to extend this wave higher. We've got consolidation for the last month. We have this double top and we haven't broken. We've just consolidated, and look at your lows. You've got a series of higher lows. You've got this little, if I were to draw a trend line right here, on Kansas City wheat from this low up to here, and if I take this high down, you've got a wedge. Sorry, I got to come right down to here. You've got a wedge that got blown out yesterday. So we're looking higher now on Kansas City, and and I certainly think that this old high of 586 is going to get at least challenged, and that reading is going to hold until the bottom of this lower trend line gets blown out, which is down at the 550 level. So I don't see anything on Kansas City that gives you pause. Nothing on corn. Nothing on beans. The trend is your friend, and you got to stay in it because it's just going to keep on chomping higher. So let's look at new crop real quick. All right, this is new crop beans. It just hasn't caught fire like the nearbys, and you're starting to hear the bears talk that that's bearish, and I disagree. It doesn't need to go yet. What it needs to do is consolidate, build a base, get into its acreage war, and then take fire. So I think if we get a little consolidation, really all the market's doing is preparing these new crop prices to lead the next leg higher. I don't think that that there's anything on this chart. There's no divergences. There's no weaknesses. There's just nothing on these new crop charts that screams sell me either. Because what are they going to do if the nearby is out and we're running a deficit on soybeans because our balance sheet is negative hypothetically? What are they going to do? Go to 9? No way. That's just not where that market's going to go. You got to look higher on the new crop stuff and not sell it yet because this actually looks really healthy to me. So in new crop corn, it's the same way. Let me get out to the daily chart here. New crop corn, this is DEES 21. Spread this out. Look at this is just a perfect up move. You've got no weakness on this chart at all. There's no divergences. There's nothing to give you pause. It just hasn't joined the party yet, and we're already at above $4. Once that front month accelerates and the back month starts to catch fire, I think this moves a lot higher, not anything else. So until something changes on the balance sheets, I don't see any reason to think that we're going to do anything except for continue to get tightened. And all of that is just the grain fundamentals. It has nothing, and we haven't even talked about the dollar yet. If the dollar implodes because we're going to print, another 3 trillion, that could really accelerate buying to the U.S. here anyway, because you've got a weak dollar and you've got strong demand. We couldn't have a better recipe going into the winter, and so we're definitely looking to the upside. All right, that's all I got for you. Sorry to be overly bullish on this. I'm bullish as a natural tendency anyway, so take that with a grain of salt. There's a lot of risk in markets. You can lose money trading, absolutely. But as we look to make marketing decisions, we want to make those decisions because the market's telling us to do it. And certainly, in my opinion, there's not a reason to be taking any major marketing decisions in the next year's stuff yet. And even the stuff that you still own, I'm comfortable holding it at least until we get a little bit further into the South American weather. All right, that is what I got for you. I will talk to you next week. If you have questions, please give me a call.